Okay, so in this video, this is Professor Hildebrandt. I am going to work some calculations out from Chapter 6 of the text. Its main focus here from this chapter is our circular flow model, and I'm going to illustrate how we calculate GDP, okay? And we're going to do this calculation. The book talks about two different two different approaches, the expenditure approach and the income approach, and here I'm going to use the expenditure approach. In this example, I will show how we do GDP, net taxes, and then also disposable income. So just to review here, here's our circular flow model. We'll use this sum to talk about how we're going to go through these calculations. If you've read the chapters, hopefully you have, we start here, okay, with our firms, and they're generating revenue, which becomes someone's income, okay, which we call GDP. But our workers earn their income, they then pay some taxes. So we say those taxes here, they leak out of the income flow. Those taxes go where? Well, they go to the government, okay? And the government then decides to redistribute some of that income to other households in the form of transfer payments. And so those two we will use then to calculate this value down here of net taxes. This then gives our households what we say is their disposable income. So it's the income earned, that GDP, minus their net taxes. Once households have that, they then make the decision, are we going to spend it? Are we going to save it? Okay. From savings, we also see investment spending happening by firms. We see government spending happening by different forms of our government. And then we have our interactions with the rest of the world up here. So imports, those dollars leak out of our system, okay, because they go into other countries. And then with exports, those dollars flow back in. And so that gives us our final equation here for GDP. It's C plus I plus G plus net exports, or X minus M. So I've written out here the equations that we're going to use for this calculation. Again, GDP is found by adding consumption spending plus investment spending by firms, government purchases, and then the value of net exports, which is this X minus M, exports minus imports. The second calculation that we'll do is net taxes. Net taxes is taxes minus transfer payments, so the second one here. And then the third calculation will be disposable income, which simply is just the first GDP minus the second net taxes. So that one's the easiest, most straightforward. So here's some data from a hypothetical country. This is in billions of dollars. One thing to note, you're not always going to need all of the information that's given to you when you're doing some of these calculations, so be careful of that. But here we give you consumption spending, exports, government purchases, income taxes, domestic investment, imports, and transfer payments. So let's talk about how we're going to do this. All right, so we're going to use this data here to answer those questions. So for the first one, how do we calculate GDP? As I mentioned earlier, GDP is this equation right here at the top. Consumption plus investment plus government purchases plus net exports, which we calculate as exports, minus imports. So I've put in bold here the ones that we'll use. This is your consumption. This is exports, the X. Here's government purchases, G. This is your investment spending, that 30 billion. And then this is imports, okay, down here. Notice that we're not using yet personal income taxes or the bottom figure there of government transfer payments. So we just plug these into our equation. So we would have 400, okay, plus the investment of 30. All right, plus government purchases of 250. So if we add all those together, that gives us 680 billion. And then for net exports, we take exports of 10, subtract from that those dollars leaving. Oh, sorry there, that should be a 4, y'all. The 40 here for imports, okay? To give us minus 30, okay? For that value. So then it's just the 680 minus the 30, And so our GDP here is $650 billion. So that's your answer to the first one. And the second one, we're going to calculate net taxes. Again, the equation is simply taxes minus transfer payments. So this one's very straightforward. And we would have 90 billion in the taxes minus the 25, okay, for transfer payments. And so our answer here is 60, that's a 5, y'all, 65 billion, okay? And then for the third one, for disposable income, we simply take GDP and subtract net taxes. So if you were to add up the values here that are in black and then subtract from them the values that are in red, you would get your answer. Or you can simply take what you calculated for GDP, the 650, you subtract from this what we had for net taxes, the 65, and we would get our answer. Disposable income is equal to $585 billion.